Gold is trying to find its groove ahead of the shorter trading week. Gold futures held their ground near a one-month low on Thursday, but our next guest says the fundamental case for gold remains bullish, and more so for silver. Joining us now from London is Simona Gambarini, a commodities economist for research firm Capital Economics. Simona, thank you so much for being with us.
Hi.
Well, after a good start to the year, we are seeing gold slowly become a more volatile trade here. Let's talk about the case for gold in 2016 and why do you remain bullish here?
Well, the gold price has been benefiting from a few factors so far this year. So first, we had safe haven demand on the back of the global financial turmoil. We had also a scaling back of expectations for further US monetary tightening. And finally, more recently, it has started to benefit from rising inflation expectations in the US. So although rising rates are generally not positive for the gold price, what we have to look at are real interest rates, and those are influenced by inflation. So we expect the Fed to raise rates further than the market currently anticipates, but this will be on the back of rising inflationary pressures, and in turn, this should be good for the gold price.
So Simona, where do you see gold headed then? Which price range?
Well, we think it will end the year around 1350, so a bit more room for a rally in the gold price.
And we'll get back to gold in a second, but let's look at silver now, which you expect to outperform gold this year. Why is that?
Yes, we do expect it to outperform gold for three key reasons. The first is that silver is often considered a high beta version of gold. Therefore, since we are positive on the gold price, we are even more positive on silver. Second, silver has been weighed down by growing mine supply and oversupply over the past 10 years. And this year, it's widely recognized that it will be the first year in which mine supply for silver will fall in 10 years. So it's the first time in 10 years, so that's a big change in the fundamentals. And third, although weakness in electronics demand, which is the biggest industrial source of silver demand, has weighed down on the price, other sources of demand, like solar, for example, have been doing quite well. So we expect those factors to have a good influence, a positive influence on the silver price in the second half of the year.
So you brought up the Fed before, and the central bank really does seem committed to raising rates this year. So does that not concern you? Wouldn't that really weigh on gold here?
We have factored into our forecast. As I mentioned before, what really matters for the gold price are actually real interest rates, not nominal interest rates, which means that you need to factor in not only the nominal changes that might be prompted by the Fed, but also changes in inflation. And we do expect the Fed to hike rates 3 times this year, but we expect it on the back of rising inflationary pressures, which in turn should actually be positive for the gold price.
So Simona, what's your outlook for the U.S. economy then if you remain bullish on gold?
We expect actually the US economy to continue to strengthen, and we do expect further tightening to reflect that, but the tightening will be mostly on the back of rising inflationary expectation and rising inflationary pressures. And this is something that we are already seeing in the hard data. Core inflation is rising in the US, and that should prompt the Fed to tighten rates further. But at the same time, it should keep real interest rates relatively low for historical standards, and that should still be good for gold this year.
Simona Gambarini, thank you so much for joining us.
Thank you.
And thank you for watching. We have U.S. Global Investors CEO Frank Holmes up next.